Hello and welcome everyone to another episode of Almus Weekly Windup. This is your host Swaraj, and with me I have our market expert JK, and we will be running you through the week that has gone by. Now, coming to the major narratives this week, we saw stocks perform well despite increasingly hawkish Fed. It seems a half point rate hike is a possibility for May. We saw a lot of sell off in bonds, record inflation numbers around the world, and of course, the Russia Ukraine war intensifying over the week. So, JK, I want to talk to you about the bond sell off which has happened this week. Some are saying it's the worst one till date. Is the current situation different from the previous bond market sell offs you have observed?
Good morning. Yes, sir, this is one of the worst sell-offs I have seen in the bond market for a long time. This has happened in the face of central banks, including the Fed, looking to tighten policy to combat surging inflation. Like, why this has happened now, though we have been talking monetary tightening for quite some time now, is the inflation rate has shown no signs of moderating, and every successive month has shown new multi-decade high. Secondly, the war in Ukraine has only worsened the supply chain issues, which will add to shortages and result in even higher inflation. Thirdly, Powell's speech in a private event on Monday, he reiterated that if Fed needs to go faster on rate hikes, they will do so. More Fed members have voiced the need to go for 0.5% increase in May as well as June. See, in bond market, like any other asset class, we see more and more macro investors cutting losses on the portfolio as the prices collapse. The last time we saw a similar rise in yields or loss in bond prices, which I can recall, was in the late 90s during the Asian currency crisis. But in a way, that is incomparable, sorry, because the size of the market now is manifold. And it's very difficult for central banks to arrest the decline now without an accompanying change in the fundamentals. See, just to get a perspective, less than a year ago, we had global holding of nearly 19 trillion of negative yielding bonds. And that has now dropped to less than 5 trillion. And that was seen in 2015 last. For this trend to stop, we have too many wishes to be granted. War should stop, supply chain issues should ease, inflation should come down, and import bans also should ease. All this will take time, and hence the yields are likely to remain higher, bond prices are going to go down. Also, the fact that the US economy is actually growing well, confirmed by many of the recent data as well, is a supportive factor for Fed actions to go ahead with their planned rate increases, perhaps at a much faster rate. One more thing to remember, we have not even started the balance sheet reduction by the Fed. So that will again add fuel to the fire. So the end of this sell-off is nowhere in sight.
Right. So just to sum up what you said, so we are seeing tightening monetary policy, which is to combat inflation. Inflation numbers are not easing. The war in Ukraine is also the situation is not getting better there. The Fed is more hawkish. They are ready to rate hikes even at a faster pace if required, and the balance sheet reduction has not even started. So, as JK said, we are not seeing an end in sight for this sell-off as of now. Uh, Now, I want to shift to the oil front. We are seeing oil trade above $115 a barrel. This has not been a good news for the Indian economy, but we have achieved the $400 billion merchandise export target this year. How do you see this fit into the rupee weakness narrative which is going on?
Yeah, it's a very important area of concern for Indian macro. The oil price going above 100 and staying above that. Now, of course, achieving a 400 billion mark in exports in this financial year is a big landmark. It's good for economic growth and also for generating employment. But what counts for rupee is the overall trade deficit, which is still increasing. Since September last, we have been seeing close to 21 billion of monthly deficit on an average, which is a way higher than 15 billion that we used to see pre-pandemic. Oil, which averaged less than 80 last year, is now trading 20% higher. As oil happens to be one of our major imports, the deficit is only going to go higher unless the crude prices come down. Already estimates of current account deficit this year is over 2.5%. And I'm sorry, that is for the next financial year. And there are challenges to bridge the same, resulting in lower balance of payments. And any country which has a challenge on the balance of payments is likely to see its currency come under pressure. I do not foresee a negative balance of payments, but definitely it's going to be substantially lower. Also, remember the fact that due to financial conditions tightening elsewhere in the world, flows into India is going to remain, much lower. We can only count on the long-term foreign direct investments to remain strong so as to maintain BOP at a slightly manageable level. So this is the scenario. Exports going up, but deficits also going up. Rupee will naturally be under some pressure because the demand supply gap is widening. RBI will supply whenever there are deficits in dollar inflows with his reserves, but that will not be sufficient to keep a sustained strength in the rupee unless the oil prices come down and the import bill comes down.
Right. So even though we have reached record export numbers, our fiscal deficit, our trade deficit keeps on increasing. So speaking about rupee, in the world of currencies, I wanted to talk to you about the Japanese yen, JK. What a weakness in yen we have observed this week. Can you tell our viewers why this weakness is happening and what could be the implication of such weakness in yen?
So there are several factors that has suddenly seen this yen's phenomenal weakness, and we are closing in on the level of 125, which was last seen in 2015. Just to give you a perspective, in 2015 also, we had seen US yields rise to 2.5%, that is on the 10-year, and at that time, USD yen had reached a high of 125.86. We are almost there as far as 10-year is concerned. So dollar yen has some more catch up to do if that is to be kept as a benchmark. But look at the fundamental drivers. The US is on a rate hike path and it's going to be faster going from here. And the neutral rate is going to be 2.5 and probably they will go beyond the neutral rate and up to 2.9 to 3% by next year unless there is a big change in the inflation scenario. What is Japan doing? Japan has not seen really inflation, which would concern them, and their economy is still to do well, and they are keeping the rates in the negative territory. So the widening differential between Japan and US is one of the biggest factors. Also, the Japan central bank continues to buy financial assets from the market, both the bonds and ETFs, which is pumping in more money into the system or more yens into the system, which people look to deploy abroad. So selling of yen continues for this reason. Then Japan earlier had historically a current account and trade surplus, and now that has turned into a deficit in the last 2 months. It had a current account deficit of $10 billion in January. And what has contributed to it is the oil price. And the oil is one of the major importing commodity for Japan as well. And along with countries like India and China. And Japan is also a resource deficient country. So general rise in all commodities, including something like semiconductor and all that, is going to only add to their import bill. And this will be increasing their deficit. And that will mean that yen will remain weak because of more demand for foreign currency. There is one more thing that is happening. As part of the stimulus, Japanese government has allowed university funds to invest their money, which is to the tune of 80 billion abroad. So this money is going to come into the market for investment, and yen supply is going to increase even more. So you are not seeing an end of this trend. Now, come to the other side. Japanese yen weakening this much, or perhaps about 8% in the last 2 months, is not going to be liked by US. US has a trade deficit of around 60 billion with Japan. So they import a lot more from Japan than they export. So known policy of US is to protest any weakness of their trading partners' currency. And if that is more due to a deliberate policy of that government, they are going to protest. And this is very much on the cards if yen breaches 123 and starts to move towards 125. So left to the market, yen's trend is very strongly a weakening trend, but policy makers or the government's actions can slow down, but we are not seeing a turnaround in the trend anytime soon because so many fundamental factors are weighing against the yen. So that's the scenario for yen, which is likely to sustain. But we will watch out for US reactions to this phenomenal move in the yen, as well as what the Japanese government is going to do in the coming days if it continues to weaken.
Right. So yen is in a weakening path, but we have to watch out for any sort of protests from the US. That was very insightful, JK. Thank you for coming in this week and taking us through the week.
Yes. Yeah, we are closing in on another financial year in India. And I think the next few days are going to be, in fact, it's also a financial year end for Japan. Normally in Japan, during the financial year end, we used to see some strength in the yen because investors used to repatriate their profits by buying yen, but that's totally absent now. So anyway, financial year end will always give some volatility either side, and with so much happening on the war, inflation, interest rates, etc., I think the next 4 days of trading in this financial year is going to be quite volatile, and I wish everyone all the best.
Right. So as JK said, before the end of this financial year, we are going to have a volatile session. I hope everyone has their risk management practices in place. Till then, I'll see you all next week. Take care. Bye-bye.
Thank you.